We'll kick it off. All right. Well, it is 10 a.m. sharp. Welcome, everybody, to our market report. Thank you for being on. I know we'll have several of our agents jumping on over the next few minutes, but thank you for being punctual and being on time. We always like to start these things on time. So, my name's Johnny Christensen. If I haven't met you personally, I'm the regional director here for Keller Williams, Utah. We do these every quarter. Our main man, Gordon Payne, always huge shout out to him. He is our statistician, our local economist here at KW Utah. Spends a tremendous amount of time putting these together. We love brainstorming and gathering more sources and just try to make sure not only are we going through the normal market report, but there's always a handful of new things that Gordon will feel is vital and market of the moment type of statistics. So we always will go over those. So. Thank you, Gordon. And she needs no introduction, but she is going to get an introduction. My co-host this quarter is the one and only Lee Stern. If you haven't
Oh,
had the pleasure of meeting Lee, she is an icon. She's a rock star. We celebrated her 50th year having her real estate license at the Wards Gala a year or two ago. She has tremendous wisdom, experience. She has been in the agent role. She has been in the leadership role. She was the regional director in the past. She actually helped launch a lot of the franchises that we still have today here at Keller Williams. She is a rock star, and I'll tell you, she is one of the hardest working people I've met. And I'll tell you and warn you now, if you ever go up against her at a listing appointment, you might as well just cancel that appointment because most likely she's going to beat you. So, welcome, Lee. How are you?
thank you, and very glad to be here. Welcome to everybody that's on board so we can look forward to 2026.
And you've seen a few shifts in your career, so I appreciate your wisdom on that, and we'd love to hear some of your insights as we journey through this.
We'll do that.
So let's get started. As always, like to remind you, we put these in a PDF format at kwutah.com. Just click the resources, go to the agent resources. We're starting to see these show up more and more just with listing appointments and in your packets and all that. So we appreciate you helping get your sellers and buyers educated. And we do record this, as you can see the recording rolling. We publish that just on our YouTube channel at kwutah.tv in case you ever wanted to use any of that or go back and rewatch it. But let's get started just with UAR, the Realtor Membership Report, just Utah Association, and then we also compare that to the National Association. We saw some quite a bit of movement just there in 2025. UAR's at 18,875, 1.38 million in the nation. So we've gone down what 200,000 realtors in the country. And I want to come back to this, but I want to show you this first. Gordon had to triple check this. I saw this floating around social media, but this was NAR numbers of deals per agent across the country. This blew me away. 71% of realtors in 2025 closed zero transactions. Zero transactions. Shocking to me.
Yeah.
1 to 4 transactions. You see that about 21%, 5 to 9. But you just continue to see kind of a migration of transactions during this shift that we've been through the last several years, just going to a lot of the top producers. So kudos to you if you're in that top. If you're in that bottom, let's get you rocking in our coaching programs. But I did some math, Lee. Love some of your insight on this. Right now, if you look at these numbers just by population in Utah, right now at 18,000, one out of 188 people in the state is a part of UAR. In the nation, in the US, with our current population, it's 1 in 246 people actually have a license. And if you look clear back in 2012, after the Great Recession, when it kind of dipped down to the lows over the last, 25 years or so, the nation hit 1 out of 314 people. One out of 314 people. I always remember that 1 in 300 kind of number. So if we were to go back to that time frame, or even just the sides per agent, we would probably end up in the country around 1.1 million. So if you look at that lack of, quantity of agents that are closing zero deals, I still think we might see a lot more agents maybe jumping out of the business. It'll be interesting to see.
And we'll see that more in July when board dues are
Correct.
coming due.
Yep.
That's kind of when that decision gets made these days.
Yep. So you see the percent drop right there, but down almost 7.5% this last year on that. Which again, for our rocking agents that are committed and here, most likely you are the agents producing that are even on this call, but getting that sides per agent moving in the upward direction can be beneficial for all of our great agents out there. And then the other one we've saw just with that lock-in effect of mortgage rates, we've got 81% of mortgages in the state of Utah being under 5%. Two-thirds of all mortgages are under 4%. People wanting to stay in their home because they don't want to swap that 3% rate for a 6% rate. So the tenure has just increased up to 9.3 years. Even just look at that last previous time frame, tenure was 6 years. So just kind of that turnover slowing down a little bit as people are staying in longer. But let's just recap in general, and then we'll start jumping through the categories that we normally do just of the real estate market. Here is the snapshot from the end of the year. So a lot of the stats now recap of all of 25, comparing it to the previous years. But new listing, we know there was more listings that came on the market. We ended with 63,603 listings came on the market, increase at 8.5%. We saw pending sales. Those under contracts tick up a little bit, 1.9. We look at the nation kind of flatlined on closings. It kind of slowed down a little bit just in the fall, but we still were up 2.2% in the state of Utah. Closed sales ended at 43,000 closed sales. We know days on market with that extra inventory kind of coming on the market. Days on market's gone up to 64, 14.3% increase. And the median sales price 2.4% increase. We were seeing a lot of those projections, somewhere around 2 to 4%. So we ended up right up at 2.4% median sales price across the state. What those sellers are receiving from their original list price just went down 0.5%, 96.4%. Affordability went up a little tiny bit, just as we saw rates come down towards the end of the year, up 4.1% affordable. Inventory of homes, we've saw more inventory, up 21%. So not only more listings came on, they were sitting on a little bit longer. Month supply, 4.2 is where we ended up 20% month supply of inventory. So we'll dive deeper into each one of these categories, but there is your snapshot. Again, that's a great one just to print off and put it above your board. But the story of, the story of the market, Lee, which has been in every news outlet ever for the last several years, is just mortgage rates and what they're expected to do. Here's three of the main forecast, sources that we have. Fannie Mae's forecast is the most optimistic, but we ended right around that 6.2 average fixed rate mortgage. You see Fannie Mae's projecting a trend to maybe hit those fives by the end of the year, but really still kind of hovering around that six. You see the Mortgage Bankers Association forecast, the green line. They feel like it's hovering, maybe even going to stay at that 6.4 on average throughout the year. And then Wells Fargo forecast 6.2. So you just don't see a lot of movement, kind of hovering right around there, maybe high fives, but still a lot of those low six numbers throughout the 26 year. Here is another projection out there from a lot of the major sources of data, but moderate home price growth in 2026. So you see everybody but the MBA is projecting positive appreciation. MBA is just a tiny bit of depreciation. Bank of America is 0%, all the way up to NAR, which tends to be the most optimistic usually, but NAR is projecting 4%. So again, probably the average right around that 2% appreciation if you average those out, 1.6. And then more homes will sell in 2026 than the last 2 years. So I think that's another thing that you see a lot of commonality on just projections, more closings. If you haven't subscribed, Keller Williams has the Keller Williams Market report that they put out every single month. Our own Keller Williams research department is projecting somewhere around 4.4 million existing homes sold. These numbers include existing and new homes sold, which we'll get into. So 4.75 million homes sold last year in 2025, which includes existing and new, which we'll get into, but just about another 10% increase this year. So we see some more closings coming on the market. Lee, what do you think the indicators or what do you think is happening that would cause more to sell this year?
I think people are just settling in on the fact that 6% is the rate. And I think my projection is it will be somewhere between six or 5.5 and 6.25. And I think that's where we'll be all year long, which honestly is a good rate. It's not what people knew for 8 years, but
Mhm.
for those of us who've been doing it for 50 years, we're like, six is such a great rate. So I think people are just going, okay, it's not going to happen. So it's time to go ahead and buy. and
Yeah.
prices are going to go up. Whether it's 1%, 2%, they're not going to go down.
Yep. Yep. And you just see this collision of all sorts of things just dealing with our economy. There's some things that are positive. There's things that are, working against us a little bit. But the quantity of dollars, the billions, they throw around billions so easily nowadays. But the AI investment has really been a positive thing on the economy. Some of the tax cuts that we've put into law now. Even a little bit of that rate going down, lower interest rates has helped as the Fed's cut. They obviously kept the rate the same yesterday in the announcement if you didn't see that, but we're coming off, three consistent rate cuts from the previous announcements. Major Utah projects, a lot of these major developments, a lot of the, construction the state's doing, just the strong conservative economic fundamentals we do, those are all positive. But then again, you look at the economy, immigration, the tight labor market is having a negative effect. The tariffs, throwing out tariffs here and there has definitely had some negativity. Even the Fed, Jerome Powell chair, mentioned those yesterday. Inflation above target still. We've made a lot of improvement the last couple of years, but even inflation still being above that 2%. The consumer sentiment stuff still feeling expensive. A lot of the surveys and indexes come out for consumer sentiment, the geonomics, and then just again, the biggest issue is affordability, housing affordability. So here is the average effective tariff rate on all imports. It's another one that Gordon found and threw on here. Up, just look at that, just giant increase, right? So 15%. So no doubt that has had an impact on the inflation. But even Jerome Powell said, that could be a potential positive sign that the natural organic prices are stabilized, maybe even seen some decrease, but even just the inflation still being where it's at, could be a one-time tariff type of influence. But then
And
even the
what he
AI, right? Go ahead,
what
Gordon.
he also said yesterday is he feels that the majority of the tariffs have run through the economy now,
Mhm.
which I think is a good thing for him to say. Let's hope it's correct.
Because what he's meaning is it has already ran through, so it's really going to have that one-time impact potentially on
Right.
inflation. So as soon as we get past that one-time effect over that, year period of time, we could really start seeing that inflation stabilize back down to the normal level we were.
And the growth really start growing.
Yeah. Well, and you look at artificial intelligence, even the main technology companies inside of the S&P 500 have just been what has moved it. So if you look at the far right, S&P 500, excluding the AI investment over the last 3 years, the price return, earnings growth, EBITDA growth, CapEx, but then you look at the growth of AI is just off the charts. So no doubt that is a major economic driver right now. Just the data centers, AI investment, robotics investment, all that
For
has
sure.
definitely had a positive effect. So here is the U.S. existing home sales to 4.1 million right there 2025. So flatlined. I know we were projecting at one point when we did these 4.2, 4.3 for 25, but I think we kind of just settled in and just 3 years in a row right at that 4.1. 2026 projections right there 4.25, as high as 4.4, 4.5. I've seen different sources, but definitely an increase. Um, Here is your just monthly. You can kind of tell where some of the seasonality comes in. But let's look at new homes. New homes, 15 years. We've been below that 696,000 average, but still 2025 projections are going to end up somewhere flat line from last year, right around that 680,000 new homes built. So when you add up the 4.1 and the 670, that's where you get the 4.7 total homes sold from that first set of
Keep in
slides.
mind, keep in mind some of these slides, I still don't have year-end numbers because of the government shutdown. So most most of these that are year to date are third quarter numbers.
And the projections of where they'd finish the year. Right. Okay. So Utah, we saw that, a little bit of growth on the closed units. We ended at 43,000. And you can see that green line if you haven't paid attention to that the last couple of market reports, but that's percent of households per sell. So again, we tend to be really low right now on the percent of households in Utah that are selling. So I think even when we start seeing those mortgage rates consistently hover around 6%, I do feel you'll start to see more of those people that own homes unlocking, selling their home, buying a new home. But again, our biggest challenge on lack of closed units still is going to be those first-time home buyers. That affordability challenge with people getting into that home ownership for the first time. Home prices, again, the country, we ended at 414,000 median price across the United States. Projection, just the one and at 1.6, 2% appreciation, projecting to finish the year at 423,000 median price. If you look at that trend line of the 4% consistent appreciation, still slightly above that trend line. Here's just by month. You see kind of the seasonality show up. You start the year out, we start seeing the price increase a little bit. We start seeing it go down a little bit towards the last half of the year, and then average out over that overall percent increase. But here's the U.S. median home payment, principal and interest, 20% down, $2,110 on median home price. Someone purchasing a median purchase price with a median interest rate, putting 20% down, that would be their payment. So just the average payment right there with the average interest rate. Utah prices, Lee, you've seen a lot of this. Some of the stats that you see just from like even the 1990 to till now, over the last 35 years, we have been one, if not the highest appreciating markets out there, just because we were so far below the national average, and we've just no doubt outpaced that with our population growth, economy growth, but just our pricing out there. So, any comments on pricing from you, Lee?
Just that the demand, was so high for so long because we were the very best place to move to, start a business in, as far as affordability and lifestyle. And it's gotten our price high, which is why I think we've got to be doing some targeting on those people who have built up that equity since 2011 and make that a focus point for this year.
Yeah, yep. Here's your home prices by month. Still a little bit of seasonality, not as extreme as the nation, but you just see a little bit more consistency over the last 6, 7 months. But then here is our median home payment right here in Utah. So median purchase price in Utah, interest rate, median interest rate, 20% down, $2,616. Annual household income to afford a median price. So this is a new slide that Gordon pulled. So this is income needed based on a 10% down payment, average annual 30-year mortgage. This does include some private mortgage insurance with just that 10% down, 149,000 for a household to afford a median purchase priced home right now. Here is comparing the United States with Utah. You just see over the last 4 or 5 years, just us separating and just over appreciating the United States. And really it was that 2021, 2022, those big appreciation years post-COVID. But here's the homeowner rate comparison, which this is, somewhat of a concern. I would think that 25, once that data pulls out, would be a little bit even lower. But, we ended up at the mid 70s, for a long time, but we started dipping down to the 60s over the last couple of years. Still outpacing the United States. We've always had a higher homeownership rate, but we're starting to trend closer to the nation now, right at that 65% line. And this is one young adults, 25 to 34, that are living with mom, grandma, grandpa. We've seen that almost double over the last 10, 15 years, right? So you look at the early 2000s, you got the 10% of people in that age category were living with their parents, grandparents. It is now journeying to 20%. So Lee, clean out those bedrooms. Let's let some of them grandkids live with you for free, I assume. Maybe you'll make them pay rent. I don't know, but we'll see. So Lee, here is I always love this one. This is one that's we have the last year lack of data, but I still love seeing the trends on this. So again, Lee, I got in somewhere around 2007, so right when that Great Recession's happening. I knew nothing but that drop, that steep drop. We kind of climbed out of that. You saw just the pandemic boom, the high inflation, the Fed raised rates, and it just felt like we fell off a cliff. The Fed lowering rates, but kind of getting back to just that 4% appreciation. But you've seen a couple before that. You saw the housing bubble, in the 2000s. You saw the savings and loan crisis Any wisdom or insight on some of these swings?
Well, truthfully, the day I moved to Salt Lake City, October 10th of 1979, rates were 12.5%, and they just continued rising to 17.5%. So that was my starting point in Utah. And thankfully, it's gotten a whole lot better, which is why I think I have better perspective about the interest rates being at 6% than a lot of people do. Everybody still wants to own a home, no matter what the rate. They did even at 17.5%. We just need to focus on where do we find the people and how do we make that work? Because they're there. We just got to help them through it.
Yeah. Because back in the, late 70s, when we just saw that incredible appreciation, the double digits, 16%, again, they just start significantly raising the rates to slow that down. But the speed and even how high those mortgage rates got high, no doubt is a whole different world than what we experienced going from three to sixes, right?
Yes.
Okay. Here is just U.S. home prices on annual appreciation. Again, you saw some of that COVID time, 18.4%. Last year in the nation, 1.3%. But really, over the last 35 years, other than Great Recession, like you said, just consistent homes don't go backwards in value.
Right.
Here's Utah. Because of that 25%, that 13%, we were unique in seeing just negative 5% appreciation in 23. But I think even just 2, 3, 4%, if we can kind of hover around there, I just think that could be a very healthy phase for us. And we look just at Utah and the nation, but if you zoom into regions, amongst the United States, it's kind of interesting what's going on across the country. If you listen to that Keller Williams market report, they go over some of this. But like the Northeast, for example, in 2025, the Northeast region where they kind of pull up all that data, Northeast appreciated 6%. But if you actually pull up West, the West region, which we're included in, the West region went down 0.5%. So it actually depreciated 0.5% in the West region. Whereas Utah, we went up. So most likely that might be California or some of those other markets that are kind of overall bringing us down because they saw some actual depreciation. U.S. inventory, again, we're matching the U.S. inventory now. So 4.2 months of inventory annualized. We always talk about that 6-month trend line, which is a balanced market. Anything above that is a buyer's, anything below is a seller's market. Great recession, post-Great Recession, 10 months of inventory. Just remember houses and houses being on the market. So even 4, it feels like it's gone up, but still 4.2, even the journey to 5, still very healthy. Buyers have options. Sellers are still selling in a speedily time frame, but 4.2 months.
Can I
Uh,
just pop in for a second and tell
yep.
you my favorite market is when the average time on market is 4 to 6 months when it's a level market, because sellers need us to sell and buyers need us to find something.
Yeah.
It's the true balance for us.
So even if it goes up a little bit, we see a little bit more inventory come on the market this year. But projections are if closings are going up, we might not necessarily see it going up to 6 months, but that yeah,
But the
four to
four is
six.
great.
Yep. Yep. Here is new single family housings units completed. So here is in the thousands. You see that average right there at 1.2 million. So we finished right around a million single family houses completed last year. Annual months of inventory, like I said, we matched the US officially 4.2 months here in Utah, 4.2 months in the nation, up 17.9% from last year. Here is new listings, 63,000. So we're back to 2020-ish, getting close to those numbers. The 15-year average is what we finished at. 63,000 listings came on the market, up almost 10% of listing inventory. Again, you can kind of see that seasonality on a month-to-month basis. More things coming on just in April and May. Great time to sell in those summer months. But here's the percent of new listings sold. So you look back even in the Great Recession, we were at 1 out of 2, 1 out of 2 in 2011. So you put your home on the market, you had a 50% chance it was going to sell. We climbed all the way up to, 90%. So you had a 90% chance of your home selling at that time frame. We have settled back down to around 63%, which is still, pretty healthy. I think even that 2020, 2021, just, the people were just throwing prices on houses a little crazy. But again, that's a healthy number to be at of 63, 60, 70%. U.S. inventory of homes for sale, right there, Utah, 175,000. Months. Pending sales trickle up just a little bit, which could be, more listings coming on, a little bit more under contracts, which is kind of the pre-indicator of more closings ticking up. Average days on market, 33 days on the market in the US. So this does not include the under contract period. So that's why there's always a little bit of a difference on the way that Utah tracks it. But 33 days on the market before under contract, 13-year average, 38 days on the market. Where if you look at Utah, 64 days on market, and that does typically include the under contract time period. 64, our 15-year average is 55 days. Mortgage rates, again, this is the main lever that we'll see just when they go down a little bit. You see a spur of activity, more mortgage applications, start seeing a little bit more refinances, but here is annual average. So we averaged all last year 6.6%, which is kind of just a little bit lower than the two previous years. But really, it's been that journey towards the end of the year that I even heard of some fives being thrown out there. But again, some of the buy downs and credits and whatnot that you can do. But 6.19 is where we averaged in December. Here's the weekly, just over that fall period of time, getting through the holidays. And probably about a half to maybe 0.6% difference between the 15-year fixed and the 30-year fixed. Here is the Fed funds rate. A lot of realtors say the Fed funds rate is directly connected to mortgage. There's a lot more math and algorithms and indicators that go into that. But again, you see just that the gap 3.72 was where the Fed funds average rate was. So about what? Almost 2.5% above that Fed funds rate was the average mortgage rate. Typically, the closer you see that get, the more confidence the mortgage industry has in the future of mortgages. The farther you separate, sometimes they have a bigger gap between the Fed funds rate just to kind of bake in some of the risk that they see down the road. But again, here's the story. Me and you talked about this yesterday, Lee, but just the quantity of mortgages, that lock-in effect, people staying in those mortgage, everybody that's got a low rate, they calculated if they were to move, how much more their payment would be. So in the country, 74% of mortgages have rates of 5% or less. 34 plus the 22. So what's that? 56% of mortgages are under 4%. So over half. Even more extreme, just here in the state of Utah, 80.1% of all mortgages in the state of Utah have a rate of 5% or less, where it's about two-thirds, 65% have a rate of 4%. So when you're out there talking about mortgages, you have a 65% chance they have a 4% or lower rate. So I bet this comes up a lot. Lee, I know you're still a listing machine out there. Any way that you're communicating to sellers on when they're wanting to buy something?
I am, and I am running into it a lot, and I think everyone should be running into it. I think this is absolutely one of your target areas for this next year, is those people that they've sat on their houses now for roughly 3 years of not doing anything longer than that if you think about the time they've lived there. But if their house was wrong 2 years ago, it's really wrong for them now. And so, whether it's empty nesting, downsizing, whatever the reason, if it's wrong for them, they're tired of waiting. And so, I think we've got to focus on those folks as far as, knowing about bridge loans. I've had two of my clients that have done bridge loans to buy the right house, and then we go and sell the old house. And that's worked out well. I think making sure that we are letting them know keeping that house as a rental with the rental anticipation for need for rentals, that's going to be an investment, another asset that's giving them money every single month in retirement because they're all, at least for my clients, almost all of them are paid off and have no mortgages. Talking and knowing the buy down plans you can do and how far down you can get, and talking more about mortgage payments than interest rates, where they may end up having a higher rate. They've got a huge down payment. So their payment may not be bad no matter what the rate, because if they're coming in with two or 300,000. In many cases, they're coming in with two or 300,000 or all
Mm.
cash at this point because of that savings account that house has become that they don't owe
Yes.
any money on or own very little money. So I think getting knowledgeable about those items and then targeting that group, talking in my newsletter about, if the house isn't right, what are the options when you've got a 4% mortgage rate or no mortgage at all and you don't want to have a 6%. So you and your lender need to get together and get really knowledgeable about that and stay on top of that because I think that's a big piece for us this year. They're
Yeah.
tired of waiting. They've waited long enough. They're impatient. The house is just, it's harder on their knees to go up and down now than it was 2 years ago.
Yep. Totally agree with you. And if we get that sustained 6% rate throughout the year, I do see us having just a lot more of those move up seller lists, where they're selling and they're buying. That lock-in resell inventory will start moving a lot more, let alone if we briefly could touch those fives. Builders have really just been the swing supply for us the last couple of years, just due to their ability to kind of offer more credits and whatnot. But I think that is the target list of people that own homes, they've been there a while, that they've waited long enough. I think the first time home buyers, that's a whole nother category that, is a different set of scripts, a different, strategy. We still have
Yeah.
a lot of affordability challenges in there, but like Gordon and I were talking about just before everybody jumped on was just Gary Keller was talking about that K economy, 8, 9 years ago. And it's just, you're starting to see a lot more people pick up on that just people that have not been in the market continue to have more and more of those challenges.
Well, I always think about South Jordan. Sorry to all my, or happy for all my South Jordan people, but I think about the gigantuan houses that they built in the late 80s and 90s that were perfect for the family of four kids and they're just big and 2 stories. And now the two people that are living there have bad knees and hips. The kids are all gone and the grandkids aren't even coming to visit that often. They are so tired of mowing that lawn and cleaning that 3 stories that they're cleaning. That's a farm area that I think somebody should be geographically taking on neighborhoods like that
Hmm.
because those people really are ready to move. They just need to have the conversation with you about how they can make that work.
Yeah, yeah. Yeah, and even a lot of the economists, 2027, I do think is just going to be a fantastic year. And it's just 2026 is still going to be a more positive year, I feel like, than last year. But it is a time to no doubt go to work, earn that market share, set yourself up for a very successful 2027.
Yeah.
So the Fed, not only they have that Fed rate, but again, we always usually track the mortgage-backed securities, the assets held by the Fed. They started purchasing, a lot of those assets back in 2009, post-recession. But you've seen that downward trend, which has kind of had that second lever, but besides the Fed funds rate. But we've gone down from what 2.7 trillion down to 2 trillion of the mortgage-backed securities. You start seeing even total Federal Reserve assets. We peaked around almost 9 trillion held by them. We got down to 6.6 just barely in December. But if you can kind of look through those percentages, it started going up. They actually started buying them a little bit more just for a brief time. They stopped that again. But again, just seeing that kind of level off is another good sign that we're moving in the right direction as economy. All of our mortgage friends out there, they've started seeing a little bit more activity. So here's the purchase index. So these are the mortgage applications coming on. You saw just a little bit of a pop up, 6.6% more came on of that index. This includes all those government loans, conventional. But here's just the weekly. So again, we got at the bottom 127, but even 194. So pretty significant increase for them. But then even mortgage credit availability moved in the right direction. Saw that trickle up a little bit, just more overall credit out there for mortgage. And then here is the refinance. So even a lot more wiggle percentage-wise, a lot more movement on the refinances. You just almost went to zero refinances there for a little period of time, just when rates cruised up so fast. But just here, even just 37% increase in refinance applications in 25 compared to 24. So moving in the right direction on that. Um, so here, foreclosures popped up in a conversation we just had, Lee, but here is U.S. historical foreclosure activity and rates. Total filings in quarter 4 was 111,000 in the country. Up from previous quarter, we went up 10%, up 32% from a year ago. So no doubt we saw a little bit of foreclosure activity increase. I know those percentages seem pretty significant, but really it feels like more like a normalized conditions, signaling a continued shift toward more normalized market conditions. Still very low below that crisis level. So despite annual increases, foreclosure activity remains significantly below pre-pandemic levels and far below peaks seen during the last housing crisis. So even just when you see that appreciation kind of just being those low 2%, I think you'll kind of just see this getting back to even a more normal level. The foreclosure situation is different. So here's the 4 years of the housing crash: 1.3 million, 2.3 million, 2.8 million, 2.9 million. I feel like it was almost every third property I looked at when I was showing a house back then was short sale, foreclosure, bank owned, REO, some sort of category of distress. Last 4 years, you can see just a whole different story, but 324,000, 357, 322, 367, still a different market.
And
Uh,
this is a really good slide to show your buyers and sellers because a lot of the crash bros are talking about all the foreclosures that are coming, and they've been doing it for the last 4 years, and we're flatlined.
yeah.
Everybody has too much equity to be ending
Yeah.
up in foreclosure. That's just the truth at this point.
When we were double digit appreciation, even if you bought a year ago, you still were in a good spot to sell 12 months later. But when the appreciation slowed to what it did, clearly that's where we start seeing, we almost went to zero foreclosures there for a minute, but now we're starting to see just a little lower level, but still pretty normal. Here's US affordability. We made some improvement, which is good to see, but not significant, up 3%, right at that index ratio of 100. You see just, peak was 2012. We went under that line for a bit, but hopefully, even as we see maybe a little bit more rate movement down towards the average of the year, that might get a little bit better. But affordability is still a challenge with a lot of our first-time homebuyer categories. Here's Utah affordability, 77 on that same index scale, 4.1% increase in the positive direction, but still need some more movement on that. Still one of the biggest challenges you realtors, you agents out there are facing. All right, recapping kind of the main categories before we jump into investment properties, Lee. Any other home sales, price, mortgages, inventory? Any final comments kind of on some of those sections?
A couple other, or another thing that I have been focused on these last 2 years is what I call my youngsters, those first-time home buyers. I'm finding that I'm looking at a lot of houses with ADUs. Last Sunday, I was over at one that I closed in October that they're putting in the ADU downstairs. We bought one with a separate entrance. That's being done. I have another one that's got tenants moving in this month from about 3 months ago where we put in an ADU. Part of it was there, the bathroom part, the entrance part. We just put in a little kitchen. Talking to our people about that, I'm also noticing right now that where again, want to talk about rates and stuff is what and payments is what those buyers want to talk about. But I'm also remembering to talk to them about the credits that sellers are offering, assumable low interest rates that sellers are doing or seller financing to cover those smaller mortgages at that lower rate, and just buy downs in terms. So get really good on knowing that information. I'm having some parents are co-signing with the kid or a brother and sister buying together. I think we'll see different combinations of people buying houses. I was really tickled to find out that 25% of all the first-time home buyers, or all the home buyers last year, not first-time home buyers, were single women.
Hmm.
And I
Interesting.
thought, go girls. So, ladies, step it up. We got some girls we need to help.
Yeah, and when you look at the average net worth of a renter versus a homeowner, we clearly know that just we've got to be professionals. We've got to go help negotiate hard for our first-time home
Yeah.
buyers. It's a concession battle, it's a payment strategy battle. Obviously, they'll never get that perfect rate right now, so just keep pushing those
But it
first.
is a wealth building thing. And so having that first initial consult about just building wealth, whether they're going to buy now or going to buy in 5 years, at least having the conversation, setting them on the path to make it happen, because they're not
Mhm.
teaching this in high school and they're not teaching in college.
Yep, yep. Well, let's jump into the investment world. I know a lot of you represent investors or are investors yourself. Here's a couple things that Gordon found from the John Burns consulting firm out there. So this is the market share. You've heard this in the news when Trump came out and said he's banning institutional investors. But here's the market share of U.S. home purchases by institutional landlords. Those usually are in the category that own 100 plus properties. Right there, 1.2%. It's usually around 1% of the purchases end up in that. There was that small time frame that kind of made news and headlines quite a bit, 3.1%. Even specific markets was a decent amount of the closings were happening in some of the markets that they were targeting. But still pretty low. If you look at overall who owns the single family rentals, those institutional investors, over 1,000 single family rentals owned, still 3% out there. Even if you add those smaller national investors, which is the 100 plus, you still end up about that 6%. But 80% of the single family rentals out there are still the mom and pop, the 1 to 9 single family rentals. Um, Here is average rental rates. So rental data is one of the challenges out there, just getting accurate rental data. So here's one of the sources that we at least have to 2024. But you see Weber County, Utah County, Salt Lake County. Kind of feels like it just flatlined there for a little bit. A lot of the projections are we're going to start seeing some rent increases come up as demand sharpening, but just pretty much flatline 24, 23. You can kind of see that right here just on the bar graph, Davis, Salt Lake, Utah, Weber County. Here is the market rent study that's set for HUD for all the federal housing assistance programs. So this is, any down, assistance programs that they're actually contributing from a government program. They set the rent in every county for the different 1, 2, 3, 4 beds. So you look at like Summit County, for example, a 4 bed, the HUD limit that they set is 3,492. Utah County, 2,449. So depending on what county you're in across the state, you can look at yours. Salt Lake, this is one of the accurate sources. Salt Lake average rent, 24 to 25. We actually saw, again, decreases. So the 4 bed, 3,100 down to 2896. Looks like pretty much every class of rental in 25 went down from 24 across Salt Lake City. And then you're comparing that, which HUD tends to be always a little bit lower than market rent that we track, whether they're behind or they're setting a little bit lower. But they actually were fine on the studio, the 1 beds out there
And
too.
HUD's generally almost 18 months behind on collecting rent data. That's why when you see the CPI, they're still seeing raises when it's not really happening.
Hmm, interesting. So here's the most updated housing profile. So here's some of the narrative out there just in Utah. The rental housing crisis is primarily caused by a severe shortage of homes affordable and available to renters with the lowest incomes and the gap between low income and the high cost of housing. Only 30 rental homes are affordable and available for every 100 extremely low income households. Utah needs to make 48,000 more homes affordable for extremely low income households by expanding access to rental assistance and building deeply affordable rental homes. The average income limit for a 4 person extremely low income household, 32,000 bucks is the average income there. But again, 48,000 potential units short for the low income renters. I know there's a lot of discussion. There's always bills coming. There's always programs that are launching, but I still don't think we've made significant progress on figuring out how to solve that gap. Median ask rent, rolling 3 months for all bedrooms. So you can see kind of flat line the last couple of years. Even some of the apartment multifamily data that we track, they're projecting, it's starting to get back to maybe potentially 3.5% increase on a lot of the apartments. So we'll see if some of the single family rentals follow that trend. But here is just pretty much from what, 2023, early 2023 is when we kind of almost have been at those same rental rates. Gordon, I don't think you've done any rental bumps on your rental properties like I have.
No, the last 2 years I've kind of tried to stabilize and make sure that I didn't have those expensive turns.
Yeah. Well, a lot of the landlords that have just really tried to be the top tier of market rent, I think that's where we've seen the increase in vacancy. They turned it over, they weren't able to get exactly
Yep.
what they want. If you were kind of just a little under the market, which is usually my strategy, I like to always kind of just be conservative, have a good tenant, give them a little bit of discount on the rent. I haven't had any turnover in my rentals, on that. So just depending on kind of what your strategy is and the risk that you take being top of the market. United States average rent growth, again, backwards, just 0.7% the last 2 years, but again, flatline the last 3 years. Kind of seen that over time the last 5, 6 years. U.S. new build for rent. So here is 2 or more units completed. You saw what, 24. You just saw an incredible amount come online. We were talking about this early before everybody jumped on, but just we almost kind of oversupplied the city of Utah. You even saw a lot of luxury multifamily apartments, kind of popping down in Salt Lake City. And we've kind of just been absorbing that over the last couple of years. So I just think part of the projection you're seeing is we're going to have a significant demand, maybe later this year, even rolling into 2027 on shortage of the rental units that we're going to need. Apartment units delivered per year. Again, just I've said this story a couple times, but we were even meeting with a couple construction companies that build apartment complexes 2 years ago. And 2 years ago, one of the ones significantly said they had 19 projects that were ready to dig and start going vertical on it, but because rates started going up so quickly, they paused all but two of them. Two of the 19 went out of the ground. So that's where you're seeing actual apartments, units, projections just going to kind of almost feel like it's falling off a cliff. So I think you're starting to see a lot of developers, some of the bigger construction companies starting to actually greenlight some of their projects, even though the numbers don't necessarily make now, but they're trying to future pace some of that future demand. Apartment units delivered per year, apartment buildings permits pulled. Look at 2024, just the apartment buildings permits pulled just was very low. You're starting to see it come back a little bit. Salt Lake County really popped after 24. But let's talk vacancy rates. So here is Utah compared to United States. Purple will be Utah. United States will be that blue teal color. 24, you saw 4.8% vacancy, 6.8%. So we tend to trend below less vacancy here in the state of Utah. But here is as of quarter 3. So this is one of the ones that always takes a little longer to get. But as of quarter 3, you kind of saw that pop. I noticed this significantly in Utah County. Kind of popped up to 9.4% vacancy. Salt Lake County, 5.6%. Again, Davis County, we've talked about that the last couple of quarters. That was a significant pop.
Davis continues to surprise me, and I think it has something to do with the military base up there where they've got a lot of turn.
Yeah. Annual average operating expense per unit. So this is average as of quarter 3, 2025. So depending on your county you're in, the bottom number is monthly, and then the top is yearly. So Utah County, for example, the average operating cost. So this is not mortgage payments. This is just the operating costs outside of the mortgage payments. Utah County, pretty much $1,000 a month across the board, those different counties. Washington's still a little bit better. Weber County, Davis, a little bit more affordable on operating costs. And then property taxes, you've seen just property taxes per unit per year. Salt Lake County leading, but pretty much flatlined in a lot of those counties. But you did see a pop in Utah County property taxes. I got notices on all my Utah County rentals, and they all came back a little higher than they were last year. Salt Lake, even our commercial building, Salt Lake actually went down a little, whereas Utah County popped up a little bit more.
No.
Okay, any comments, Lee, on cap and our investment category?
Couple of things that came in. One from Tony, and when we were talking about ADUs, he said using renovation loans instead of your own cash for those buyers. They should ask their lender about rental loans. He even said he's got an ADU going on a new build with a reno loan, which was a game changer. And then on the bridge loans, Justin Bouchard in our Brickyard office does those. So if anybody needs a bridge loan, that is another resource for your clients to check with. And speaking of Justin, he leads our wealth building mastermind every month. He's done this for several years now. It's probably the best mastermind we have. And it's all about investing, whether you're investing for yourself or you're learning investing better so you can serve your clients better. When we talk about all these rentals and things, I think those are a mastermind that could be beneficial to those people, those agents.
Yeah, I just think overall it just feels like a very positive aura right now. I think a lot of our investors have been kind of maybe just watching and sitting on the sidelines a little bit, but as you come out of this winter season, start moving into that spring season, like it's go time. So all of you
Well,
investors out there, yeah.
Allie Adams yesterday was at the um, commercial symposium downtown on investment property, and she's like, "Holy cow! Everybody is so hyped on Utah and the investment and the growth opportunities for investors coming in downtown area, all the way up to Park City, all on the Wasatch Front, the ski resorts, just all sorts of things positively happening in commercial investments.
Yeah.
So again, get knowledgeable about that so you can have some play in that game.
Yep. Yeah, you could do all the right things in the wrong season and end up with nothing. But like
Yeah.
these are the times, this reminds me a lot, not necessarily exactly, but like coming out of the recession after that kind of that shift, we started buying rental properties and it was just a tremendous, decade for us to own stuff, and I think I'm starting to get very excited just over the next year. It's a big growth year. I think it's a good time to start accumulating some more rentals, be creative.
Well, and Josh has always said, Johnny, when the market is slower, and in our case, it's level, it's not slower, it's up from last year, it'll be up a little bit more this year. But when it's at that level or spot, this is the time to really jump in and reconnect with your SOIs. The
Mhm.
market share you gain during this period of time is market share you never ever lose. So it's the time to invest in the relationships you already have or and just make them deeper, better relationships.
Yeah, totally agree. Well, let's jump into the U.S. economy, and then we'll touch on the Utah economy, but we'll go over GDP, unemployment, some of the inflation numbers out there. But real GDP, again, the economy is growing in the United States, also driven a lot from that just infrastructure, the AI, the data center kind of investments they've made. But last quarter three, 2.3%, 2.8%. If you look at just overall, unemployment, still pretty healthy. Anything under that 5% is a very healthy job market. The resilience of our job market still is very impressive, but we trickled up just a tiny bit, 4.2%. And even job openings, the U.S. unemployment. So you look at job openings, 24, we just dropped. We had so many job openings coming out of COVID. There was more jobs out there that way more than there was people unemployed. It was almost like two or three jobs for every one person unemployed. We've started going back up with some of the growth of companies out there. But this is one of the things Gordon always points out is just when these lines cross job openings versus the unemployed people. So you see 7.83 million unemployed people in the country is kind of where we ended the year. We crossed kind of right at the end of just job openings. So I think you could start seeing some of the outcomes, maybe of some of the immigration laws, that's happening, but also some of the AI, efficiencies, companies maybe not hiring as many people. You'll hear a tech company laying off people here and there just as they're rolling. But here is even just dialing into the regions again, job openings versus job quits. You look at West percent of job quits, and then percent of job openings, which again I think we get sucked into that category. Overall, we still had a positive Utah, but I think that is a lot of California influence. So I'd love to see just statewide California data on some of these categories.
Yeah, and
But here,
I like that slide because it's actually good data compared to some of the other data we pull from the Fed. And it basically shows in the West, people are not job hopping. They're hunkering down for the next little
yeah,
bit.
yeah. Real unemployment versus the U6. The U6 includes just, underemployed, marginally attached, discouraged workers. So always ends up being a higher number out there. Here is the annual labor force by age group. So you look at the 55 and older category, which is that purple line, usually around 35, 40%, but we're hovering right there at 38.1%. And then 25 to 54, which is the blue line, still, at top numbers right there, 83.6% of 25 to 54-year-olds are employed. I don't know what the other 17% are doing. Maybe they have trust funds. Gordon, do you have some trust funds you've been giving out?
They're living in grandma's basement.
Gaming. They're gaming out there.
Yep.
U.S. working age population 20 to 64. So here's some of the, the demographic things that could be affecting this. Like you see 2011. when we start dropping, the first baby boomers hit retirement age, coming out of that recession, if they were even close to retirement age, you just saw some people just choosing not to get back into the workforce. You saw, kind of how low we got. Immigration from 22 to 24, really surged to 3 times normal levels. So you just saw a bunch more people kind of getting into the workforce, but even the projections 2025, pretty much, flatlined right there, just as some of those new immigration restrictions were coming on. And then real wages. So real wages isn't wage increases. Real wages is also inflation weighted. So as inflation goes up and down, like does it actually feel like our income went up? When inflation was so high, even though job incomes were going up, it didn't feel like it because your spending power went down. We've been moving in the right direction the last couple of years. 25 still shows most likely a positive on that. But we spent a lot of time on this during the crazy inflation days, but we'll just touch on some of these, the CPI, the PPI, the PCE. But inflation made a lot of progress over the last couple of years. You see the CPI, which includes energy and food, ended at 2.7. The core CPI, which excludes the energy and food, just because some of those end up being more volatile, but still very close, 2.6%, getting very close to that 2% trend line. I think some of the tariff effects, I think if the tariff, stuff hadn't happened, I bet we'd be, really close to that 2%. Here is the projection in 2026. They feel like we'll end up at 2.3 and 2.4% of inflation category, really getting on track with that 2%. But where does that all come from? So here is, when we've seen interest rates kind of journey downward last year, that's been positive. That's actually helped us move down in the inflation number. Real median input, rent growth, even home prices. We were one of the big drivers of inflation at one point, but now we're actually helping some of that move downward. But some of the big categories you'll hear, natural gas is up. So if you're a heavy natural gas user, you've kind of felt that for sure. Food in general kind of just is up still, kind of averaging around that 3%, but food away from home, food at home, food combined. Throw a few DoorDash fees on top of that lead, probably even higher. But then even just electricity is up a little bit, fuel, oil.
And
Producer
go
price
back to that one,
index.
Johnny.
What?
So if you look at the rent growth and owner's equivalent, those numbers are about 18%, or sorry, 18 months previous. And that's why I put the actuals on there on rent growth, because like the housing assistance this is the housing assistance, what it's based on.
Mm-hmm. Because they're just late
So
to the party with the numbers. So
they're
their
just late to the
actuals.
party. And
Yeah.
I think realistically, inflation is running lower than they're actually saying
Yeah.
it is.
So we could even be a lot closer to the 2% trend line, even with the
Yeah,
tariff stuff. Yeah.
yeah.
Producer price index, you kind of see just right around that 3% number. Personal consumption, we like consuming things here as people. You saw just the COVID swings, but still up 3.5%. The personal consumption expenditures, market-based personal consumption. This excludes food and energy, up 2.6%. Amazon. It's Amazon's fault. We keep ordering stuff on Amazon. Here is the revolving consumer debt. So seasonally adjusted. This is in billions. We were cruising up after COVID. So that was very concerning for us. We've at least kind of stopped that increase, but we haven't really made improvement in it. So getting our revolving consumer debt on average, with all of the population, getting that down would definitely be helpful. We're following the lead of the government, no doubt. They continue to go in debt, 36 trillion as of the end of quarter three. Total average public debt per GDP, right around that 120. So we've kind of almost hit that 120, and we've hovered there.
Johnny, Justin just sent a text in on the chat. Is the inflation rate at which goods are continually increasing? If it stabilizes high, we don't have inflation.
Yes.
This comment.
Yeah. Mm-hmm. Because that's not saying prices have gone down. They're still gone up 2.6% on average over the last 12 months. They just anticipate 2% growth of those prices, every single year. So if it actually became a negative number, that means our eggs, our, electric gas, whatever, was actually lower now than it was a year ago. Federal debt, annual personal savings rate, right around that 5%. Still need to get that up a little bit, but 5.1% is where we're at 2025. Average deposits going up in the right direction a little bit, 3.8%, which also can help the credit availability out there with banks lending. Manufactured durable goods, purchasing managers index floating right around that 50. Again, if you're above that 50 is considered expanding, but kind of staying a little status quo. Advanced retail sales, all those retail places ordering, in advance, up 4%. Already ordering for Christmas. But again, here's the direction and the rate of change. So manufacturing, new orders, production, employment inventories, all that. You see more in the contracting, kind of shrinking phase. It looks like we only have a couple in growing. But any comments on this, Gordon?
Well, this is just kind of a precursor of what's going to be happening over the next 6 months. I mean, we always watched this when I was a purchasing manager to, to kind of adjust our inventories. If we saw things start slowing down, we would pull back as well.
Yeah, yeah. You see car lots a lot more full these days. U.S. Index of Consumer Sentiment. So we ended up at 57.6. Again, that index trend line. The Utah, a lot more positive, a lot better outcomes of that consumer index. We were journeying up the last several years, but right at that 81, pretty similar to where we were last year. Here's on a month-to-month basis. Got as high as 91 right at the end of 24. But now let's just compare that to the Utah economy real quick. Again, Utah, just old Utah, what I grew up in versus kind of the new Utah. We ended up, small state. We're now a little bit more of a mid-sized state, more populous. We're at the 30th population rank. A lot of internal growth is old Utah, 34% of growth from migration. Whereas now new Utah's really a lot impacted from that external growth. 61% of growth from migration, partly because, migration's kind of been moving up. Our fertility is officially below replacement level since 2018. We're trending a little bit more older. Still, we win a lot of awards for having a median age in the lower category, but 20% age 65 and above, which again, old Utah was 9.1%, even just 15 years ago. Less multicultural, 9.5%. In 1990 was racial ethnic minority. We're now 23.3% in 2022. The projections 2040 is above 30%. Definitely getting a lot more diverse, which I think is positive. Strong economy, moving to an elite economy. Really having just an elite economy. Our job growth consistently top in the nation. And just a lot of post-COVID outcomes that we've seen a lot in those positive categories. But again, one of the negative ones, we just went from affordable to an unaffordable housing type of market. Utah housing costs represent major economic risk for us. Here, constantly winning awards out there, but fourth most favorable state in annual employment growth, fifth highest labor force participation, 13th lowest unemployment rate, third highest median income, second lowest poverty rate, still the youngest at 32, where the US is at 39 years, still largest household size, 2.88, whereas the US is at 2.49. And then county share. So a lot of the population growth that we saw the last year and a half, this is where the counties grew. So a significant, above a third of the population growth was all Utah County, which is reflected from a lot of that South Utah County, West Utah County growth, a lot of housing, a lot of even just major projects. 18.7% of the population growth was in Salt Lake, Washington, 10.7%. Weber, not too much growth, 3.5% out of our population growth. But even look at Summit. Summit, just 0% of the population growth was Summit. Here is the projected population growth. So this is where it's going to all end up, right, Gordon? So this is where you might want to plan some of your next 40 years of your realtor career strategy. 771,000 people are coming into Utah County in the next 40 years. 370,000, just those dark red. We see just clearly across the Wasatch Front down there in Washington, 175,000. Utah County adds by far the most new residents over the projection horizon. And we only have one freeway, Gordon. We only have one freeway down here. We got to do something. Bring on the drones. I'll fly in a drone if I have to. I did some math. I think every year we add 30,000 or something cars to I-15 in Utah County. I was doing that math the other day with not real plans of us. If you talk to anybody that lives out west, Utah County, that Pioneer Crossing just makes them want to pull their hair out right now.
It's hell.
Yes, it is
Hell on
actually the
earth.
the worst road stat wise for UDOT right now. So I know they're trying to improve it, but even once they get done improving it, it's still going to end up being one of the lowest uh, ranked roads out
Slowest.
there. Yep.
Yeah.
I actually rode 2100 North. I jumped on that new road that takes you straight to Mountain View Corridor. It was so
Uh-huh.
slick. I love that. Nice and
Yeah, I
easy.
love that one too.
So here's Utah economy overview, just in general, quarter four and year end. Just a couple of those highlights. Utah retains its national leadership with strong unemployment, with employment and just low unemployment. Job creation just continues to be great. Our population, workforce, just really has helped underpin our resilience and housing demand. The housing supply improved, which was positive. New listings rose modestly. Inflation moderated 2.9%. The challenges that we consistently talk about, just housing affordability, labor market tightness persists, just us having a lower unemployment out there, just at 3.6%. Pending sales fell, kind of just that softening right at the end of the year. But just in general, Utah continues to top national economic ratings, just with robust unemployment, GDP, fiscal, growth in tech, healthcare, construction sectors. Just a lot of positive things still there. Again, here is our unemployment for Utah, just still under the nation. Here is GDP growth just for the different states. You could see a couple of them beat us, but 4.1 for Utah, very positive. I don't know what's going up in that Northeast, but there's been a lot of growth, a lot of positive things going on in the Northeast sector. Real GDP, as you see that going up. Flip through a couple of these. Personal income growth. Utah, for the first time, just quarter three of 25, just under pacing a little bit of the United States. So hopefully we see a little bit of a pop here, a couple quarters of 26. But let's just hit
And
construction and
the
then we'll kind
the
of
other
keep
thing
going.
that affects that is the inflation.
Yeah,
So I think because the data is backdated a little bit, I think it's affecting that a little.
right. So some just finishing kind of our last category in construction, new single family home starts. We talked a little bit about this, but still 13 years below. We've got to find ways of getting builders building a little bit more. I think our long-term problem is solving that shortage of supply. We got to get more moving, maybe 1.2, 1.3, 1.5 million over the next several years would be very healthy for the inventory levels. Here is housing, residential building permits is the orange. The total building permits is the purple. So again, peaked in 2021, downward trend, but 25 moving in the right direction, at least with total permits out there.
Johnny, can I ask a question?
Yep.
When we're talking about the affordable housing, do you know if um, Utah's legislators are looking, or cities are looking at finding a way to do lesser impact fees, more affordability on that end? Because I do know that a part of our challenge for the builders is the cost for the cities are just going up so much.
Yeah, Gordon and I talked about this, and I was venting on my in my leadership meeting a week or so ago. Just we've seen estimates anywhere from like 20 as high as 40%. Gordon had a source of 40% of the cost of a home can actually be traced back to some sort of government tax, influence, regulation, or whatever. And again, one of the challenges of just when you have legislature is just I think it was Chris Kyler that told me this. Just every city council, state legislature, you look at federal government, all these people get newly elected, and they all think that their goal has to be to go past their one law, right? So you just see constantly 500, 600 bills every year in the state going up for, vote, pushing those. So it's just every year we're just seeing hundreds of new laws, hundreds of new laws, hundreds of new laws stacked on, the existing law base. So it just becomes this giant web of complexity to do anything, and part of it, I think there was at least a couple bills that was trying to deregulate, trying to get some of the impact fees. I know our, legislative committee, just as far as RPAC goes and at the state, we're like 99% batting average. So I know there were some that they were really supporting in a positive way. But you also see, some of the tech people coming out on what the impact that AI will have on some of the efficiency in building permits approved, getting through some of the red tape, even just some of the understaffing has definitely affected it. But I think that is one of the biggest categories out there that we could help solve some of the affordability. Even some of our rock star realtors that we've been in the market the last 20 years are serving on different boards and committees. So I think there's more resources going to try to figure that out, but I don't think we've seen any specific thing that's actually started moving the needle downward on that. But I think we see the light at the tunnel a little bit
And
more.
it's not just the permits in the state and local. It also affects the building supplies and how they are restricting some of that as well.
Hmm.
And
It
people don't
just it
realize, you know, what
it just
that,
can be frustrating to have Governor
yeah.
Cox and the legislators all saying we need more affordable housing, we need affordable housing, and yet in my mind, a fair amount of our challenge is with the government entities in trying to accomplish this goal. So I'd like to see them be, I don't know if it's held accountable or brought into the process to say if it's 40%, the builders can do their part, the landowners can do their part, but and the buyers will buy it, but
Yeah.
you've got to do your part.
Well, and when I was on RPAC and the legislative committee for several years, back in the day, and what I really realized is, the best city councils and the best, boards and stuff like that are actually made up of realtors, business owners, people that are very savvy on the economic growth. And even people on this call, like I just think more of us have to actually go get involved, running for city council, running for some of those state offices, because I think we've got to be a part of that change that we need on a lot of that for sure.
Thank you.
Residential housing starts, you can see just the value, purchase price is affected on that, just the increase we had last year. Price index of single family houses under construction, some of those indicators that just still will predict a little bit of positive appreciation in 26. Here's builder confidence. We kind of went backwards a little bit there for several months. Here's the month. You can kind of see those trends, but builder confidence, again, towards the end of the year, started moving in the right direction, but still overall average in the high 30s. And then just let's look at debt a little bit, just wrapping this up. Here's total debt balance and its composition. You see just mortgage debt out there, the trillions closing in on almost 15 trillion of mortgage debt out there. You could see just the red student loan, probably almost a couple trillion there. You see the credit cards have gone up over the last several quarters. Here's origination by credit score. Still a lot of green out there. Been really difficult. Credit score under 620. Even in that orange, if you're under 659, just small percentage of the mortgage originations. I'm sure our mortgage people are working a lot with just credit repair. But here's auto loan originations by credit score. Debt balance by delinquency status. We ended up, record lows coming out of COVID. We've started seeing a lot of those trickle up a little bit, but still under 5% in all those categories, combined. Severely derogatory is the red. Percent of balances 90 days late. We talked about this last time. Student loans just has to do more the legislation. Are they forgiven? Are they not forgiven? Whatever. Some of those people didn't even know they were going in delinquent status, but mortgages still very low. HELOCs very low. Autos trickled up a little bit. And then even just those other categories, but really credit card. You've seen the most movement in credit cards, upwards of maybe 12% of balances in delinquent status. Transition into serious, kind of still a little bit more upward trend other than the other category, credit card. Number of consumers with new foreclosures. We talked about foreclosures a little bit, but here's bankruptcies included in there. 141,000 bankruptcies, quarter three. Third-party collections. Proportion of consumers of collection went down, but average collection amount per person is kind of still up there the last several quarters. And then that concludes our slides. So final closing speech, Lee, piece of advice. I know you've been giving us a bunch of nuggets of wisdom, but any final things out there?
Stack your deck and get in relationship with your people. Stack your deck means do the work that's in the areas that we see are going to be important and coming up and providing income opportunities for us. And then just use this year to delve deeper into your sphere of influence and build those relationships on a more relationship level. And
Yeah.
that's it. There's
Yep.
business out there. I just want them to get their unfair share.
Do the basics. Stay in touch with your SOI. Hit your 36 touch. No doubt it is a time to go gain that market share. I still think we'll see, some of the bottom of the realtors getting out of the business, which still just frees up more transactions. So now's the time to absolutely go get your unfair share. So again, thank you all for being on. Gordon shared that again. We have these in PDF format and recorded for your use with all your clients. I encourage and challenge you to share them. It helps you retain a lot of this information. But thank you for hanging in there. And really, thank you, Lee. Thank you for your wisdom. Thank you for being our guest host on this. And join us next quarter. Thanks, everybody. Have a fantastic week and weekend. See ya.
Bye all.